Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. I'm Michael Bull. Thank you for being with us. This segment is brought to you by Bull Realty, Asset and Occupancy Solutions. Visit bullrealty.com. Today, we have a special show for you. This is the Tax Cuts and Jobs Act is what we're going to talk about. Early this morning, the Senate approved this bill, and it's to have significant changes to the taxes in around the country for companies, for individuals. So we're going to look at the impact. We're going to look at the facts. We're going to look at how it might impact decisions if you run a business, if you own real estate, almost if you do anything in the United States. So please welcome my first guest, Mark Van Deusen. He's principal with the Washington National Tax Group of Deloitte. Mark, thanks for joining us today.
My pleasure, Michael.
So let's, Mark, if you will, briefly, tell us some of the highlights, some of the major changes that you see in this headed for us right away here.
Well, Michael, I think that the headline news is that the changes in the tax rates, that for individuals, the highest tax rate is now going to be 37%, down from 39.6%, and the lower rates are also below that are going to be cut as well. Also, the thresholds at which the rates apply, those have been raised so that if you look solely at the tax rates, there's going to be, for lots of folks in the United States, a significant tax cut.
Yeah, and that's interesting because Ryan, Speaker of the House, Ryan suggests that a family of four with a median income of $73,000 will have an extra $2,000.
They are significant tax cuts, especially at the lower rates. There are nuances here. If you are a high income earner and you are in a high income tax state such as New York or California, although the tax rates are going down, the ability to deduct state and local income tax or property tax or sales tax is going to be capped at $10,000. So for a lot of people in those states or who otherwise have large state tax deductions, the benefit of the lower rates may be mitigated or completely offset by the loss of the state tax deduction above $10,000.
Right. And then also you have a cut in the corporate tax rate, right?
Yes. This was one of the major drivers for tax reform, is that our corporate tax rate of 35% is significantly higher than our competitors in the developed world. If you look at Ireland has a 12.5% corporate tax rate. And the new bill will reduce the corporate tax rate down to 21% effective 2018. So that is a 14% reduction in the corporate tax rate. And the real theory behind that is that's being done in part to make sure that our multinational corporations stay headquartered in the United States and aren't moving overseas to benefit from the lower corporate tax rates that our competitors impose.
Yeah, I mean, that sounds like the most intelligent thing we've done in a long time. We need to keep industry in the U.S. So what about small businesses? Are there some additional benefits for small business owners?
There are. One of the major provisions of this bill, and it's a real change in how we've taxed small businesses, is a new, it's sometimes referred to as a pass-through rate, but it also does apply to businesses operated as sole proprietorships. And this new pass-through rate applies by giving a 20% deduction off of any qualified business income. And so if you do the math on the 20% deduction against the highest tax rate, 37%, that results in an effective tax rate of 29.6. So that's a full 10 percentage points lower than the current top individual tax rate, which is 39.6%.
Okay.
Now, it's for people that are operate in either partnership form or they're a sole proprietorship. This can result in a significant reduction in their business income. And the part of the rationale for this was, well, we're reducing the corporate tax rate on C corporations, which tend to be larger entities. We also wanted to reduce the rate on businesses that operate in a pass-through form, and so that's why you're seeing this rate reduction of 10% for those folks who are at the highest income levels who are operating in a partnership or in a sole proprietorship basis.
Right, like an S corp, right?
Yeah. Yes. Yep. Also applies to an S corp.
Okay.
This rule is pretty complicated. And it does make a distinction based on your income level. If you earn less than $315,000, you get all of your income is entitled to this deduction and lower rate, and that benefit phases out until it gets to $415,000. But if you're above those amounts, then there are two new rules that apply. One, you don't get that rate at all if you're in what's called a specified services business, which would include accounting, law, health care, financial services. It also includes providing advice as a trader, investor, or dealer in securities and partnership interest in commodities. It also applies to any business in which the principal asset of the business is the reputation of one or more of the employees or the owner. So take, for example, accounting firms and law firms. A lot of their higher income owners are not going to get the benefit of this. There's also another rule that says, well, even if you're not in one of these specified businesses, let's say that you own commercial real estate in a partnership form, your ability to claim this deduction is going to be limited. It's the greater of two numbers. One, 50% of the W-2 wages of the business. Now, for real estate, typically don't have significant wage income, so that on its own could have limited the ability of real estate to benefit from this deduction. But it's a greater of, and the second number is the sum of 25% of the W-2 wages of the business plus 2.5% of the adjusted tax basis of the depreciable assets used in the business. And that 2.5% number, based on our preliminary modeling, we think that for a lot of commercial real estate investors and other real estate investments where they are capital intensive, that although there is this limitation now, that particular aspect of it will likely allow many real estate partnerships to fully benefit from this new 20% deduction and 29.6% tax rate.
Okay, we're talking with Mark Van Deusen with Deloitte about the Tax Cuts and Jobs Act. So let's talk a little bit more, Mark, about the changes that will impact commercial real estate industry participants. So 1031 exchange, that escaped any changes, right?
For real estate, it did.
For real estate, yeah.
You still get 1031 exchanges, but personal property, you will not be able to get that. And so 1031 exchanges of fleets of airplanes will not apply. Also, if you have any personal property as a part of a larger real estate like-kind exchange, you'll still get like-kind exchange tax-deferred treatment on the real estate, but not on the personal property.
Okay. How about interest and depreciation? What changes do we see there?
Big changes for a lot of taxpayers, not huge changes for people who are in real estate.
Okay.
The part of the rationale of the Republicans in putting this together was they wanted to reduce the incentives in the tax code to capitalize a business with interest as opposed to capital. And the way that was done was to say that if you have net business interest expense, your ability to claim that is going to be limited to 30% of adjusted taxable income. And that adjusted taxable income, if you boil it down, it's basically EBITDA before 2022, and then after 2022, the measure is EBIT. But for a lot of people, this is going to limit their ability, who are in business, to claim net business interest expense. Importantly, for real estate, there is an exception. Anyone who's in a real estate trade or business is not subject to this 30% limitation, and that is defined very broadly to include not just constructing and developing and renting real estate, but also serving as a broker or a manager of real estate. And so that's a significant recognition by Congress of how important leverage is to commercial real estate as an economic growth driver, and that commercial real estate and people who are in the real estate industry are generally not going to be subject to this new 30% limitation on interest.
Okay. Now let's talk about carried interest. I mean, a lot of commercial real estate deals, there's a principal is putting together a deal as limited partners, and some of his profits are in the risk and in the labor he puts in, and maybe his risk on signing on a mortgage. So what's up with carried interest?
Carried interest, you may remember from the election, both President Trump and Secretary Clinton both ran on changing the taxation of carried interest. Prior versions of carried interest had set up systems under which all of the income attributable to an interest provided for providing services to a partnership, all of that income would be taxed at ordinary income rates, regardless of whether that was attributable to capital gain recognized by the partnership. The new bill does have a carried interest provision. It is significantly less draconian than anything that has been proposed to date. And the way that this would work is it would apply a 3-year holding period rather than a 1-year holding period in determining whether you have capital gain from a partnership interest that was provided for providing services. And so if you were to, say, sell your partnership interest, your carried interest in a partnership, if you'd held that for 2 years, you'd get short-term capital gain, which is taxed at ordinary income rates. You'd have to hold that interest for at least 3 years for you to be able to benefit from long-term capital gains rates.
Okay, all right. Well, that's good news compared to what some of the discussions were, right?
Absolutely, absolutely.
And we have listeners too that are concerned about the residential home market. Impacts the economy in a big way, and especially if you're a builder. What about interest write-offs for homes?
That was another big change. Currently, you can deduct interest on first and second mortgages up to $1 million of principal, plus home equity lines of $100,000. This bill would eliminate the ability to deduct home equity line interest. You could still deduct interest on first and second homes, but the debt limit is now $750,000 rather than $1 million. And so that's kind of the headline news of the mortgage interest deduction is being retained with some small limitations. But there's another provision of the bill that doubles the standard deduction. It's now for joint filers going to go to $24,000. And the realtors they came out and opposed to this bill because they said, well, look, the doubling of the standard deduction, well, that's really a backdoor way to eliminate the benefit of the mortgage interest deduction, because now you're going to go to a world in which the only people who are going to itemize and therefore get the benefit of a mortgage interest deduction are people who have more than $24,000 of state taxes capped at $10,000, charitable deductions, and then mortgage interest. And that's a pretty small subset of the country overall. And so they viewed this as a backdoor way of reducing the incentive that the mortgage interest deduction provides for people to acquire homes. And so that will certainly ripple through to the single-family homes market, may be bad for single-family homes, conversely may be very good for multifamily.
Yeah, it's interesting because if you take away some of the other financial benefits of increased jobs, increased GDP, increased companies moving into the U.S., which obviously could benefit the housing market. You look at that alone, and maybe it's a negative. Mark, I want to get your opinion on the impact from this Tax Cuts and Jobs Act. We're going to take a short break. We'll be right back with Mark after this break. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.